Why don't we get started? Looks like we've got 29 folks in. More will probably show up while we're rolling, but we are recording this. So, of course, we'll be happy to share the recording afterwards, certainly with our panelists as well as with our attendees. My name is Sean Heberling. I'm CEO of Marion Street Capital. Our mission is helping innovative growth companies solve their most pressing challenges. Tonight, we're going to be discussing the impact of political and interest rate shifts upon the private markets. With me as panelists are Nicholas Grabowski, CEO of Flow, the company with whom we've partnered to produce this virtual event. We've got Vineet Singh from Apex Group. We've got Erich Hickey with the Green Family Office, and we've got Laura Lucas with Latitude Ventures. Why don't we take a few minutes so that each of you can have the opportunity to introduce yourselves to our guests. Nick, I'm going to start with you.
Sure, yeah. Well, thanks everybody for joining. A little about me. My background is technology and product. Before Flow, I was at Forge Global, where I helped build the broker there, the secondary market for late stage unicorns, as well as their data product. We took Flow public for $2 billion in March of 2022. Before that, at a different secondary market, which we merged with Forge, and then I worked for Charles Schwab, ran R&D, and centralized architecture for them for many years. And also had a previous exit with a company called Ebates. If any Warriors fans out there, the company Rakuten bought Ebates for $1 billion. So had some good exits, and I've spent a lot of time thinking about interest rates, given my experience at Schwab and other places. So interested to have this conversation today.
Great. And Nick, how did you get to be CEO of Flow? What does Flow do?
Yeah, Flow is a investor engagement platform for fund managers, private market fund managers in particular, VC, private equity, real estate, private credit. And we provide both SaaS and services. On the SaaS side, we provide digital investor onboarding. We provide a really robust investor portal, secure white label investor portal, and then the data rooms. And then on the services side, we do fund administration for SPVs, and we'll do and then, of course, we work really closely with Apex on that side. And we do a couple other services for funds.
And Nick, I know you guys have hundreds of customers in the private markets who are private market investment firms, as well as service providers to those firms. So your insights into the private markets will be especially interesting to our audience. Vineet, why don't we pivot to you? Go ahead and introduce yourself.
Thank you, Sean. Vineet Singh. I had a business development here at Apex Group on the West Coast and in Canada. Been with Apex just under a year right now, but prior to that, I spent 15 years with fintechs, BlackRock, eFront, Allview, Lemon Edge. Also worked at Brookfield up in Toronto for a bit. So I've been in the private fund space for quite some time. Apex is a global service provider, fund administrator with 3.2 trillion in AUA, 13,000 employees across 96 offices. So we have a strong global presence. And as leading the business development charge here on the West Coast, without giving away too much of today's topic, I'm very excited about 2025.
That's great. And Vineet, your firm is servicing roughly how many customers across the globe in the private markets?
Ooh, the numbers, like thousands of clients. I don't have the numbers, unfortunately, right now. But the great thing about Apex is that we've done a very, the foresight to really invest in the technology. I think we have a really fantastic tech stack to give value to our clients. And also, too, is that we've really expanded the breadth of services. I mean, fund managers want more than just striking the NAV. They want other services as well, to helping with fund allocation, investment, fundraising, tax, all that stuff, and Apex can provide all that.
Wonderful. Again, because of your position, you're talking to investment firms all the time, so you're in a great position to opine as to
Yep.
their outlook for next year. Laura, go ahead.
Hey, Sean, thank you for having me. Hello, everybody. My name is Laura Moreno-Lucas. I am one of the partners at Latitude Ventures. Latitude Ventures is a $100 million venture fund that invests in the early stage from pre-seed to Series A. My background is been in the financial markets. I've worked at large institutions like SunGard, which is now FIS, TD Ameritrade, and NASDAQ was my prior company before joining Latitude Ventures, where I oversaw many of the unicorns that you see on the public markets today, from Airbnb to Lyft to the Real and Zoom. And so I've also been a founder, so I've had that experience of raising capital in 2009 when, the capital markets were a little bit different than they are today. And yeah, I'm just excited to be here and share any insights that I can around the venture community, around the capital markets and IPOs.
Laura, I was
Mhm.
very pleased and impressed to learn about your background as we were putting together this event, because I think you've got so many valuable different perspectives on the capital markets that'll help educate our audience tonight.
Thank you. Thank you.
Erich, you and I have, I was just thinking about this yesterday. You and I have technically known each other for 20 years.
Yep.
So there have probably been periods where during those 20 years, we haven't spoken for maybe a year or more. Go ahead and introduce yourself.
Sure. So I'm the CIO of the Green Family Office, and we also have an adjacent foundation. The family made their money in banking. They own First Trust Bank here in Philadelphia, which is a $5 billion commercial bank. So we invest really everywhere. Somewhat relevant to this discussion on the earlier stage, we primarily invest in fintech. So we're building out a corporate venture capital unit currently in-house. My background, I ran a wealth advisor prior to joining the family. And I was with another family office in New Jersey prior to that. So I've been investing in hedge funds, private markets for over 20 years now. And I know we've shared stories about what it was like in the early 2000s versus what it is today. So I think it'll be a really good discussion.
Wonderful. Thanks much again to all of our panelists for your generosity with your time. So today we're going to cover 3 topics for our audience, and we'll do this in a pretty snappy format so our audience doesn't fall asleep and drive off the road, for those of the who are maybe in the car listening on the way home from work, if people even go into offices for work even these days. 3 topics are: first,
They're starting
political.
to get demanded to go back to work.
Oh, really?
Yeah,
Yep.
downtown San Francisco, where I am, is definitely more lively than it used to be.
And I hear you have a new mayor who is hopefully having a little bit of a positive impact.
Yeah, yet to see, but yeah, he's including, some of the big wigs like Sam Altman on our board here. So we'll see how much AI gets going, even more than we already have in San Francisco.
That's great. Philadelphia, too, has a new mayor. The business community seems to be highly supportive of her and some of her efforts. I know she's been encouraging all businesses to essentially mandate return to the office at least some part of the week. I myself am standing in a physical office in downtown Philadelphia, but that is purely by choice. Okay, so the 3 topics we'll cover today are: first, private markets outlook; second, improving speed to market for private markets investment firms. firms with technology. And then the third one, we've actually shortened up to be just private markets investing and regulatory uncertainty. So let's kick off with the first topic here, our private markets outlook. Nick, Blake on your team was kind enough to share the PitchBook capital markets review report with us. We sort of took one of the charts from there and overlaid pluses and minus signs pertaining to changes in the federal funds rate due to the FOMC actions over the past couple of years. Just a caveat on this chart, I think because it is showing each quarter's fundraising activity on a trailing 12-month basis, it doesn't really do justice to some of the severity and the change that we've actually seen in some of the quarters. But I think the audience is attuned enough to private markets activity over the last couple of years to get the gist of what this shows, which is basically, number one, the Fed embarked on all those plus signs of activity during 2022 and 2023, taking a pause in the final quarter of last year. That tightening cycle led to a pretty noticeable change in the aggregate level of private markets fundraising dollars on a trailing 12-month basis. Although, some of the quarters there, especially the later quarters, saw a much lower activity than, say, the last quarter of 2021 or the first quarter of 2022, before not just the tightening cycle, but quantitative tapering, which probably doesn't get as much attention these days, even though my understanding is technically that is still ongoing, though maybe on a more reduced basis. The number of funds raised took an even steeper drop than the dollars raised. And if you dig into the PitchBook report, the sense I walked away with is you've got fewer funds raising more dollars, and those funds are concentrated in very specific areas. Like within VC, it's AI focused. Within private equity, it's less first funds and much more later stage funds. There's almost no real estate investment fund activity recently. So maybe we could start with like a little bit of a retroactive discussion around what you guys saw and felt from your respective positions over the last couple of years.
Well, I'll go first. So there's a couple things. So I think if you look across the board, except for private credit, you saw this sort of reduction in raising. What's also not in that report, but which is a little more stark, is the deployment of the capital. So they might raise, but then less was deployed over that same time period you just talked about. And it's to be determined if we're going to see it deployed. To your point, though, another stark reality is that I think across the board, again, except for private credit, what you saw that was a lot more money going to a smaller number of funds. And that's true in private equity as well. I do think there's private equity investment in AI. So I don't think, or at least in companies leveraging AI and are putting .ai on their websites and so forth. So at least, pretending to do AI. I think that's certainly the case even in the PE space. I think another area is logistics and supply chain, where there was heavy and focused investment, especially post or during COVID and post-COVID, because that was a big driver of a variety of problems, including inflation. And historically, when there are supply chain problems, investors, in particular VC investors, do tend to invest in that and try to solve that problem. It also might be a sign that probably supercharged AI, to be frank, because AI is certainly something that's going to enable those kind of logistics and supply chain. But it might also suggest now that that's less of an issue, that supply chain is less of an issue, that you might see less investment in AI relative to everything else. I don't think it'll go down, but maybe relative to everything else, it might be lower going forward. Yeah, so I definitely think that that down dip that you've seen, so this sort of less money raised, not a lot less, but less, and then certainly less money invested, and then the focus of that money going to a smaller number of funds, and then that focus going to a smaller number of industries, in particular AI. This can be, this is largely due to inflation, and inflation was largely due to supply chain problems, and of course, a flood of government spending in the U.S. and really in many other parts of the world, and that now that that's that the supply chain is less of an issue, if interest rates can go down, that'll really help the VC market. But anyway, that's kind of my take on what you just said there.
Yeah. Vineet, what did you see across your customer base?
Very much the same thing. I mean, the last 2 years, going back to the start of 23, have been very challenging from a fund launch perspective. We love fund launches because it gives us an opportunity to service those clients. And the headwinds that Nick mentioned, specifically on the inflation, the cascading rate hikes, that to do that, it just killed the deal cycle, sort of killed the fund formation cycle and whatnot. So it's been a tough slog for sure the last couple of years. But even like anecdotally, I would say last 3 months, a lot more optimism about what's happening. I think the loosening of the purse strings on the rates is obviously a big thing too. There's also a lot more optimism about deals happening in 2025, which will obviously kick into the fund formation cycle, and hopefully, to Nicholas' point, give an opportunity avenue for that deployment, that capital that was raised but never deployed in years past. So.
Great. Laura, how did your firm react to the tight liquidity environment in the last couple of years?
Yeah, it was really tough. I hope it doesn't get worse, because the past 2 years were, really hard, not only on the venture fund side, but on our portfolio companies. I think for me, the way I've seen this is I keep telling our founders, hey, it can't get worse. And then all of a sudden you see institutions like Silicon Valley Bank go down, and things that you've never experienced before. So I hope that, next year there's not any catastrophic event that really unhinges the capital markets, because everyone right now is looking for some opportunity. And as Vineet said, we are feeling some activity in the markets. I noticed that Service Titan is scheduled to go public, and their raise is pretty significant. So that type of activity is going to help, and it's going to unlock some of the capital that'll trickle down, hopefully, to the venture market. But yeah, I mean, it was tough. I know a lot of emerging managers have had a really tough time raising their first funds or even second funds. They're taking longer. We used to see maybe potentially capital raised maybe within a year or a little bit over a year, and now it's at a minimum 2 to 3 years is what we're seeing in those fund cycles. So we're hopeful for some of the alleviation in the capital markets and the private markets that will help some of that capital flow down.
Yep. Thanks, Laura. Erich, you're on the allocator side. How did you guys anticipate the tightening cycle, react to the tightening cycle, and what are your thoughts going forward from here?
So a couple things. So I think for us now, to sit in cash, we're getting paid really well to do that. So I guess the pressure to put capital work is lower than it was before. And I think like we're getting back now to, I would say, like a healthier market 22 and 23 were slow, but then you were also coming off of like a steroid-induced euphoric market in 21 with everything that was going on. And I think like in that time frame, you just didn't have time to even like do the due diligence on a lot of direct deals. They were just trading so quickly. People were just jamming capital into everything. And then, as an investor, with a bit of a fintech tilt, you had a lot of tourists come in the space, raising enormous funds. And, whether it was self-perpetuating or whatever, you're getting a lot of kind of Series B, C things done at just ridiculous valuations, with in many cases no help of no chance of exit unless they were able to do it via SPAC or something like that. So yeah, and we're seeing kind of the same thing that the other panelists had mentioned. I would say overall now, the funds that are coming to the market are just better. I think in that 22, 23 timeframe, I can't tell you how many fund 1, 2, 3 venture funds with no DPI came to market that were marked at 2x. That I went back and I told them I have no idea if you have skill or luck or it was just impossible to make any assessment. So we sat on the sidelines and waited to see things or did a co-investment with them and really just took our time. And really that's the approach we're taking now. We have a pretty mature private equity portfolio, so we've been getting some distributions, but I know on like the pension and the really large allocators, the denominator effect is just impacting those guys where they just don't have the cash and the capital to make those allocations, regardless if the funds call capital quickly or not.
Have you found your ability to influence terms improve dramatically over the last couple of years?
Somewhat. It's like on the large funds, no, where in the size that we're allocating, it's certainly on anything direct. We're certainly at the table, and we're friendly investors. We don't ask for a lot as far as like covenants and control. It's more just information rights, board observation, those types of things. But companies are much more open to having conversations about letting us in and bring our network to the table than they were before, because it was more of a competition for investors to get that allocation as opposed to what it is now.
Okay, great. We obviously started this conversation with interest rates, which were the changes in which were largely prompted by the inflation situation that the pandemic exacerbated. What other political factors influenced the kind of tighter liquidity environment of the last couple of years?
I can chime in, I think, on the back of what Erich commented on. When valuations got really out of control in 21 and the markets were really exuberant, I think a lot of my experience when I was at NASDAQ as a managing director, just to kind of juxtapose things, during 2019, within a good year, I think I was bringing about 200 IPOs to market. In 21, there was 700 IPOs with SPACs and smaller investments, and they just kept going downstream. So it was really wild to see just all of that activity on the back of COVID. And so you knew something was going to fall out. You just didn't know when. And then you add all of the additional components that came on top of that, which created the downturn pretty quickly. We, knock on wood, we closed our fund, 100 million, in August of 22. So literally right when everything started to shut down. So we were one of the lucky ones that had, dry powder to be able to invest, while others were thinking about how things were going to, play out in 23. And then you started to see all of the major funds come to market and say, okay, let's tell our founders not to focus on growth, to really cut burn, to really, create better businesses, as Erich was talking about. And so now, yes, I think that a lot of the things that you're seeing on the market are more robust because of a lot of the changes that happened and a lot of the exuberance that happened during that time. And of course, there were other initiatives like what we talked about is in the past is ESG that also drove some of that.
Yeah, I would just add too, like heading into 22 and 23, and even the beginning of this year, like the macro outlook was not good. I mean, in 22, you know, you had like 7, 8, 9% inflation. Pretty much everyone was guaranteed that we were going to go into some sort of recession or effectively have flat growth. And you know, consumer spending and mostly the American consumer has defied that. We've been able to engineer really what looks like a fairly soft landing. And so, and then you add to that into this year, the political uncertainty. And I think going forward, like the best line that I've heard is it's like you have to take Trump's policies seriously, but not literally. And so, you know, next year we'll kind of see how all of these things are implemented. You know, he certainly looks at the stock market as a barometer of his popularity. So I don't think he's going to do things where it's going to really upset the apple cart too much. But there some things are going to happen, and you know, once those chips fall, I think a lot of people in the private markets investing in particular, you know, will have a better insight onto, you know, what the next 3, 4, or 5 years will look like.
And add to that too. I mean, you know, you mentioned the political factors. We're in a global economy right now, so we've got a couple of very significant geopolitical risks happening in Ukraine and in the Middle East right now. So how that affects the markets and, you know, how the markets are pricing in that risk it'd be interesting for sure. I think the thought is that you know, right or wrong, that the incoming administration would probably try to end the Ukraine-Russia conflict sooner than later. They'll do what they can to get an, you know, Trump's actually spoken words to that point as well too. What happens with the Middle East is you know, another issue, but obviously we see what's happening even this week with Syria. So that could have a obviously outsized impact on what's happening in our markets.
Yeah, we definitely saw post-election, immediately post-election, the funds coming to us and who had over the last few years have been really trying to spend less money on operations because they've raised less or wanted to just optimize their operations. As soon as the election ended, folks we've been talking to for months immediately wanted to sign up and use our service. And it seems very clear to me that post-election, the uncertainty, as Erich mentioned, was causing people to sit on the sidelines. And immediately several people were like, let's go. And that's still happening. And, you know, a month later, we're still getting people calling us wanting to get their new fund launched as soon as possible before the end of the year. So I think that's true. I also agree with what Erich said on once Trump takes office. I think he's saying a bunch of things right now, you know, deporting 11 million people, you know, 25% tariffs on Canada and Mexico, you know, and a variety of other things that, if he does, are going to be a huge problem for the economy and for investing. But if he doesn't do, are obviously not going to be as big an impact, or if he does a much lesser version of it, it's going to be far less of an impact. So I think there are definitely people still waiting to see what the answer to that question is. Well, certainly there are a lot of people waiting to see, but I think investors in particular, and fund managers in particular, kind of waiting to see, because it will impact them a great deal. I mean, if you're thinking of investing in something that's heavily dependent on Canadian imports, or imports from Mexico, you're probably waiting to see, well, is there going to be some sort of tariff, or is that some sort of bluff? So I think that is true. I also think there's a part of the investment community that has, you know, sort of an exuberance as a result of the change in administration. And there's this thing called All In Podcast, which there was this event that I got invited to. I didn't really know much about these guys. Anyway, I went to this event, and the irrational exuberance displayed at this event over what's going to happen now was shockingly high. And so, you know, if I'll call it the billionaire class, you know, the 13 or so billionaires that are part of the Trump administration, if there's a group of people following them, then I think there is some like real pent up kind of exuberance around deploying capital. Whether they'll deploy it wisely is a different question. But you know, I think that exuberance is out there with a certain class of investor.
And Laura, do you share that exuberance?
Well, I mean, to his point, I do see the All In podcast saying that. I think, you know, going back to what Vineet touched on, that this is a global economy now. So thinking about, you know, I work closely with a lot of LATAM investors and venture investors also globally, and they are looking at Mexico, they are looking at Canada and those areas to bring more into those spaces for supply chain purposes. And it is growing. I was just earlier this year at a conference, a nearshoring conference in Mexico City, where I saw some of the largest funds in Mexico City that I didn't think would go there to talk about how to build out more in Mexico. And then you see Tesla going into Mexico, and then you see all of these manufacturers. So you know, when the Trump administration talks about how he's going to impact things on a global scale with tariffs, and how he's going to deport however many millions of people, I do hope that some of that is rhetoric, because it will have a deep impact on how things are done. You know, if we look at just the Latino market in the US, we are the 5th largest according to GDP. That's ahead of, you know, it's like if it was its own country here. So it's ahead of India, it's ahead of others. And just the Latina contribution is 1.3 trillion, which is just like the state of Florida. So there are a lot of Latinos here that are driving the economic growth, and a lot of immigrants. So I think, you know, again, I see his you know, the conversation about what he's going to do. I hope it's you know, tapered, and then in terms of just like the activity that people are looking at in terms of the venture market and how they're thinking about that capital trickling down, I think you kind of have to have this focus of, hey, if that trickle down effect is going to help some of the emerging managers and some of the new funds that have been built to impact communities across the board, that's a good thing. Hopefully it'll impact it in the right way, whether it's across AI or other sectors. I think that's yet to be seen.
Yeah,
Erich,
let me do one other thing on that. Like,
Sure.
if the 25% tariffs do happen, that I just don't see how that can be a good thing. I mean, it really doesn't feel like that can be a positive thing for a variety of reasons. I mean, we're talking about our 2 largest trading partners in Canada and Mexico. So hopefully that is a bluff, and he's trying to get something else. It's using it as leverage for some other thing.
Erich, how's your firm planning to navigate the uncertainty with maybe some cautious optimism from the investment community?
Yeah, no, I mean, kind of the same thing we've been doing. I mean, like my outlook is pretty sanguine. I've read enough on behavioral biases in my life to understand that like the knee-jerk reaction to the election will likely fade. And, you know, I think some of the policies like we talked about will go into effect, but I don't think it's really going to be life-changing. But, you know, underlying GDP growth is pretty strong, you know, regardless, you know, Google and Apple and a lot of the larger companies in the S&P 500 are still going to generate, you know, significant earnings and free cash flow. And hopefully now with some of the deregulation that's being talked about, you know, that filters into some of the other sectors like energy and financials. So no, I think we have like a decent tailwind. But again, it's like, it's not a time to go all in. You know, the public markets have been up very strong the last 2 years. I was reading this morning, it was like only the 4th time since like 1850 or something like that public markets have been up 20% 2 years in a row. So, you know, we're just being patient, waiting things to come to us. I mean, we really like to be a liquidity provider, and we really still haven't seen any distress out there. I mean, there's a couple pockets here and there with some like more retail inefficient markets, but largely in the secondaries market and thing like that, it's been pretty quiet. And then the only other thing too is like we're really looking at like a lot of derivative, call them investments off of the secular spending around AI. So a lot of the headline stuff is quite expensive, but there's a lot of opportunity in things like digital infrastructure, kind of poorly capitalized firms, that spent way too much money, the last couple of years that need to be recapitalized, things of that sort, and just trying to find investments with relatively reasonable downside that could provide us pretty good upside.
Yep. That sounds like a man who's accumulated over 20 years of experience in volatile.
And made a lot of mistakes during that time period. So
we all did. We all did. Okay, so let's move on to our next topic. And as we switch gears here, I'll encourage the audience to submit any questions they'd like to submit. We're going to reserve the last 10 or so minutes purely for Q&A. But if I see a question from the audience along the way that pertains to our discussion, I'll certainly weave it in. There's a Q&A function on the Zoom, so please submit your questions there. Let's talk about improving speed to market for private markets investment firms with technology. So as you've heard from the panel, the panel seems to be relatively sanguine, to steal your word there, Erich, about the direction of private markets in 2025, perhaps despite the exuberance that maybe the wider community has started to demonstrate. On the right hand of the side is the Federal Reserve's dot plot. I'm not going to spend a lot of time on its nuances, but you can see that the direction of interest rates forecasted out to the future is largely lower. And so alongside some political shifts and maybe some policy shifts, maybe a little bit more pro-business type of regulatory environment, you can see how some folks in the investment industry start getting a little excited and moving maybe more towards exuberance. Affinity published a quote that 52% of global private investment firms seek greater opportunity to raise a fund in 2025. We've heard how the panel's hearing a bit about the intent of private market investment firms to raise new funds. Laura, how do you think about raising new funds, either for your firm or for some of your colleagues out there in the industry?
Yeah, so there's definitely been more new emerging managers that have come to market. But as I shared earlier, the time that they've come to market and actually close their fund has taken a longer time. So we're seeing on average, I think it's 2.5 years is what the average is for new emerging managers. So I think, when we've been looking at how we're going to go back to market over the next year, it's really looking and analyzing at our strategy closely and making sure that we have a lot of support from our existing investors, as well as looking at making sure we have alignment and showing some of the growth in our portfolio and the opportunity. Obviously, a lot of the opportunity that everybody's seeing in the market is AI. So really being able to double down on some of that, but it's early, right? So we're still kind of seeing where that flushes out. And as we talked about earlier, how some of those valuations on some of those opportunities are a little exuberant, but it's getting in at the right time. So I think that from a fundraising perspective for new managers, it's really finding out some of the gaps that are in the industry and being able to really articulate the differentiation on how you're going to tap into some of that institutional capital that, right now, if you look at just in 24, it went all to some of the big funds like Thrive and Andreessen I think they raised at $34 billion that made up 22% of everything that got raised last year. So that's a pretty significant amount that went to, some of the bigger funds. And we're hoping to see some of that change in 25 so that it's trickling down to some of the more emerging managers. Now with technology, I'm going to plug Flow because, prior to me joining Latitude Ventures, I was able to start running deals on my own through his platform. And so when you think about structurally what you need to set up outside of just a strong strategy and a strong thesis and, how to attract institutional investors, it's articulating, how you're going to be able to do that and showcase that and really put that in a way that offer speed for those investors coming in. And Flow is a fantastic platform that allows you to do that for new managers.
That's great, Laura. Vineet, what sort of advice do you generally provide to your customer investment firms who are interested not just in raising a new fund, but in raising it quickly?
Yeah, I've had a lot of great conversations with CFOs who come to me and say, look, we're raising a fund next year. I've been told we have to cap our head count. We cannot have more people. And this could be firms that do it the old-fashioned way in Excel and Word and whatnot. These are other firms who actually have, named service providers out there, but they spend way too much time shadowing and doing the management analysis reports that their partner needs. So the thing challenging now is, and I think we saw this with the beginning of the pandemic, I think the supply chain of fund accountants out there is gone or missing, or I'm not sure what happened, but it is a tough area to find people to operationally who can support your business. So I think firms really have to turn to technology like Flow or to partners that invest in technology that can allow them to scale in such a way where they don't have to worry about adding headcount next time they launch the next fund. So, I mean, the advice is obviously go with a provider that, I mean, we've gone to some providers that will, the price out their clients well, and they say, hey, we can offshore it all to so-and-so. But even other offshore jurisdictions like India and whatnot, they're coming up with resource issues too. So you have to really invest in firms that invest in technology, invest in the right technology, invest in AI now, because there's great AI technology out there that can do a lot of the heavy lifting just to provide like your quarterly NAVs too, right? So things like that are important. Also, you invest in firms that have a global presence like us. We're also opening up an office in Mexico City as well too, on operational perspective. So I think you want to partner or with a firm that is going to be able to scale with you, both in terms of technology and global reach.
Vineet, I hadn't even thought about a staff accountant shortage, and it resonates with me because I used to teach finance at Villanova. When I was at Villanova, Villanova was an accounting school, and then when I was teaching there, it was a finance school. But despite that, when I talk to my colleagues in the accounting department, they tell me every one of these students has a job a year and a half before he graduates. I mean, there's serious brain drain in the accounting space.
Yeah, here in California, it's quite acute. I had this, anecdotally cute conversation. I grew up many moons ago, so I had to send out 40 resumes to get a part-time job. My son, was applying for a job 2 years ago. My wife and I were coaching him, saying, "Hey, okay, this is how you do the interview. This is how you do this, whatever." He goes out 10 minutes later, he comes back, goes, "Yeah, they hired me on the spot." So it's just a sort of thing where I think right now there's a new paradigm shift right now where there's going to be a lot of good jobs for people, not enough people to fill them. So hopefully we do have more immigration and more people coming in because I think the country absolutely needs it.
Erich, so give us an LP perspective on technology, and when your firm is subscribing to a new fund, where are the pain points?
So now I think the biggest help on my side has been electronic subdocs that actually remember your information so you don't have to write your address like 37 times on 85 pages. you know, I remember when subdocs were like 15 pages long, and I feel like they get 10 pages longer every year. So that's one thing that I've really liked a lot. The second thing is just with like data rooms, like they're super helpful as well, particularly on the direct deal side, but even on the fund side where all the letters, and I don't need to be sending emails back and forth. Everything's just there. And most funds now just have everything available. And then the final thing is like I've seen it a couple places, and I hope it's gonna start to happen more, but there's a couple platforms that actually have like a 15-20 minute video. So it's effectively like a DDQ, like in video form, where like I review hundreds and hundreds of investments every year. And particularly on the fund side, like if I can get a 15 to 20 minute video telling the story, you know, that takes so much time away from like planning a Zoom meeting or a meeting, and really can get me to like next steps if there are going to be that, and really dig in to have, you know, I would say a worthwhile, meaningful conversation for me. And then for the GP, like they're not doing, hopefully they're doing way fewer meetings with people like me that would just effectively be superficial. I mean, at the end of the day, everybody wants to meet with a family office, but in a lot of cases, you know, I try to pre-screen up front and say, you know, we're really not interested, and it's amazing how many people still want to have a conversation. So, so those are kind of like the three areas, like for us, where I've seen technology evolve. And, you know, I haven't, like Vineet mentioned, like I think timeliness on NAVs and things like that, hopefully the AI and technology can really improve that. And then the final thing I'll say is like some of the things that we're working on with our guys is just a couple platforms where you're able to feed in financials, you're able to feed in DDQs, things like that, where it's then able to summarize it for you. Still not that great. They're starting to look at a couple different platforms and really trying to get to somewhere where it's affordable for us, and can be productive, because you know it really levers what an analyst would do for us.
Nick, what's your reaction to all of that?
Yeah, I mean, I just want to make a couple comments on something that Erich said. So one of the things we're working on, and that we started working on last summer was in leveraging AI to take information from data rooms. So we offer data rooms as a product, and then produce some sort of summary of it, just purely from the information that's provided by a data room. And so I think that's where you were going, Erich, is some sort of video that kind of walks you through it very quickly and gives you the summary of what's going on. I would love to get something out that does that, and we're doing some research to do it, because I think it would be a great tool. I've heard that from a lot of LPs in particular. That's
I thought it was a video pitch, no?
No, it was more the video pitch.
Okay.
But in all honesty, anything that helps to summarize it, because like some of the tools that I'm looking at will take all the financial information and basically go through the like liquidation and preference stack of a company. There's a lot of robust things that they can do. But honestly, if you had a tool that could take all the information from a data room and then create almost like a report from that, or something that's reasonably close, I mean, that would be like gold.
100%. That's what I'm talking about. It's a summarization of what's in there, and they're like, yeah, I mean, a pitch is I guess that would be the right way to market it, and the right thing to ask the AI to do is like, you know, pitch this, you know, pull out the important information and pitch it. So that is definitely where I think this is going to go next in terms of providing value from AI via data rooms. But yeah, a couple other things too that you know, Laura mentioned about our platform, the Flow platform. We see like folks that come to us, their LPs are filling out our you know, digital investor onboarding documents in less than 20 minutes, and that is really a compelling thing, and really moves the conversation forward, and moves the speed. Once you've got people who are ready to invest, it makes it easier for them to get in. It's just a lot simpler. They're not annoyed anymore by having to go back and forth with law firms. I mean, the 10-page, you know, the 10 pages every few years that Erich mentioned is definitely true. And a lot of the docs that people fill out, they're convoluted. You know, the attorneys have changed them over time. You have to check yes on one page, and then on page 20, you have to know that you checked yes on page 1 and answer a different set of questions. And that's just not obvious to LPs, even really sophisticated ones, because they're busy. And so our product really just resolves that problem by making it really a kind of TurboTax, like there's only, as you check boxes, there's only one way to get to the end state, and really simplifying and not repeat, you know, the W-9 getting generated automatically, for example, once you've entered the address in another part of the document. So, yeah.
Wonderful.
Can I ask Eric a question on the video pitch? Like, how long will he listen? Is it like a 5 minute, a 2
Oh, that's a
minute?
great question.
I think there should be like a 5 minute, and then I think there should be like a 20 to 30 minute, in all honesty.
Yeah. And you get that personal feel. Sometimes I feel like over processing and technologizing everything, like,
True.
yeah,
Yeah.
yeah, it could be detrimental, but I get it.
Hey,
All right, so
just so you know, you have
Go
two
ahead,
questions.
Nick.
I don't know if Sean, if you know, but you got two QA.
yes, I see those. I'll get to those. We are getting tight on time. I do want to leave some time to answer questions from the audience. I just want to make sure we kind of intentionally touch upon regulatory uncertainty. We have talked about tariffs. We have talked about sort of exuberance around a more pro-business environment. But I do want to ask the panel one question, which is, if the new administration does become friendlier to the investment industry in terms of deregulation per se, what sort of tangible impact do we think that might have? Laura, during our pre-call, you touched upon one particular topic there with ESG.
Yeah, so I mean, in terms of deregulation, obviously that'll help some of the movement in terms of like the financial markets. But on the ESG side, there's been so much built over the past 10 years, whether when I think about ESG, it's just a new word that's, basically be responsible, have governance, and be equitable to your employees, because in the prior life it was called corporate responsibility, and now we can call it whatever you want to call it, but it's really structuring, making sure that you have the proper governance in place and good board structures. It's being equitable to employees and making sure you have diversification, and then just being good to the environment and having sustainable practices in your company and your organization. So, there's with the administration coming in, there's some views on those things politically on how they'll be managed. But I think as a company, from a company standpoint, as long as you continue those practices and you're assuming those going forward, those will all be good for your investors. And as your company grows and you disclose those, I think that that's just something that all companies should adopt. When I was at NASDAQ, one of the key things that I ran for many of the companies was applying, hey, how are you going to build these practices in your disclosures for going public to attract some of the global investors? And it's just something that you should practice at the beginning as you start to build this into before an IPO happens. So I think it's more of a company decision. I think obviously the government has its own perspective on things, but I think investors still value that as part of what companies are building. And it's just coined something different, right? Because that's something that's always been happening. We just continue to coin it something different so investors can participate. So we'll see. Hopefully it continues and it stays.
Is the panel aware of any other key investment industry regulations that our audience should be thinking about in 2025?
The only other one I
Go
would
ahead.
probably add is on the crypto side. I think
Mhm.
there's been some thoughts that, especially given one of his administration, RFK, is a big proponent of crypto, that there's going to be a loosening of that to set up more crypto here. Surprisingly, Europe seems to be more conducive to doing crypto funds than the US right now for whatever reason, which is a little surprising. But I think specifically in that industry, I'm seeing a lot more tailwind to push that over the finish line.
Yeah, I was just gonna say, like one of the things that I think they're gonna have to address or tackle in a thoughtful way is just with the proliferation of alternatives downstream into more retail markets. everything's been great, so there hasn't been any crises, but we're away from like the non-traded BDC and REITs that were charging huge upfront fees, but the inherent illiquidity of the underlying investments in most of these structures, I don't think your average investor truly understands, what a tender process looks like, or only getting access to 5% of your capital per quarter, particularly in an event where the market's down 30%, or you have some sort of crisis or something like that. So I don't know how they're going to do it, but that's one area that I see there could be some issues, and where regulation is needed.
Yeah.
And having come from a regulated environment and not being in one, it is just like it's
Right.
fantastic is what I would say. And I know the guys on our bank side, they don't love the regulators too much, but really any sort of ease there, I think will be a good thing. But protecting those downstream, I think is going to be paramount.
Yeah, I'll just say one thing about this. I don't think there's going to be a lot of new regulation. I just think there's going to be lax enforcement of the existing regulation. In particular in crypto, that's going to be the case. And that is going to lead to probably problems in the area that Erich just described, in particular in these alt spaces, because it means people are going to get into this that maybe don't understand it as well. And I think that is a risk. I think the regulations are such that is still very limited by design, at least outside of crypto. That's very limited by design, all the other privates, but it's becoming less and less true.
Yeah, well, you saw some of the changes in regulation like that caused some of the exuberance that we were talking about earlier on SPACs. They went in and changed a lot of that regulation. And so we just
Price
have
has
to
been paid on that one, I think, though.
yeah.
Great. We do have a few questions from our audience that I at least want to try to field before we risk going in overtime here. So we got one about relating to trends within perhaps private credit. So Nick, you mentioned private credit having maybe been a beneficiary of the tighter liquidity environment.
Well, beneficiary of higher interest rates
Yeah.
is the key. And I think the question here about private asset-backed finance as opposed to more traditional PC, I think whenever interest rates go up, more people are going to try to benefit from that, which is why you've seen more sort of private credit generally, but even more alternative kind of versions of it. So I think as interest rates go down, you're going to see less of it. And interest rates, I mean, JP Morgan just came out the other day and said interest rates are going to go down on the 17th. A lot of people are saying that there'll be another quarter-point drop. So I think as long as that continues, we'll see that. If tariffs happen, if you see a recession, or you see, sorry, not if tariff happens, but if we don't see a recession and the market stays strong, or if you see inflation or something, things can all change. I mean, inflation in particular could cause them to raise interest rates, and you'd see these alternative private credit type things come back. So that's where I think it is.
Sean, I would just add, I'm actually looking at a
ahead.
lot of stuff in the private asset-backed credit side. I don't like sponsor-backed stuff or just generic down the fairway private credit. We also own a bank, so don't really do a lot of real estate and C&I stuff, but there's a lot to be done there. Like we did a transaction in 23 and then ended up like securitizing it in 24 with light equipment, boom lifts, forklifts, those types of things. And we're looking at a number of other kind of hard asset type things where in the event that something does happen, you can at least sell something that you own, as opposed to like cash flow lending, that type of thing.
Vineet, have you seen much in the way of differentiation between asset-backed versus asset-light private credit funds?
Not as much on the asset back side. I think we're definitely from a industry perspective, private credit tends to still be like the leader on that side, though I think the PE market's going to pick up. I think we're going to be also seeing hopefully some more happening on the venture side. I think a lot more emerging managers will come into play because there'll be a lot more I guess, searching for returns, because once those rates start coming down, some of those institutional players want allocators need to hit their defined rates for their pension plans, and they can't do it in fixed income, so they're going to be looking to source more capital to that market. I still think that right now within the continental US, things are trending in the right direction. For me, the two spots where I'm still very, very concerned is the Middle East and Ukraine on the impact of the overall market. So
Makes sense. I do want to let the panel know that we're past the hour. If anyone needs to go, no harm, no foul there. If you want to stay to help answer the 2 to 3 remaining questions from the audience, I'm certainly happy to stay with you and we can tackle these in an efficient manner. Question for perhaps Nick, perhaps to start with you. What do you think the current and future risk of implementing AI in a system that helps fund operations might look like?
Future risk of implementing AI. I mean, I don't know that, yeah, I mean, risks. There are a lot of risks. I mean, you could have, you could train a model with proprietary information, and that information could then be exposed via the model to other parties. Now, all of the AI vendors will tell you their AI model will never do that. But AI models, if you've used them at any, I have an AI model record my, my conversations like this one, Zoom calls. And I had one the other day tell me that we had as a team picked a jazz concert that we were going to go to at the end of the call. That's what it told me. And I think it's because in the background I had a little bit of jazz music playing, and it somehow decided that that was what we had decided to do, which was just insane. But so I don't even know. I don't think any of those, I don't think Sam Altman would have predicted that was going to happen if it was his AI that was doing it. And so that tells me that I don't know that they can predict that their models won't accidentally leak out information that they shouldn't leak out. And I think that is a big risk and something we should be concerned with. But I think generally, I think those risks are fairly small, and it's something that can be dealt with as you use, be careful as you use these AIs. Don't be uploading lots of proprietary information to a AI that's going to be used as a model in the public.
Vineet, what's your firm's attitude toward AI implementation inside a customer's ecosystem?
we're very, very supportive of it, and I think it's a great tool that can be used to sort of like, going back, decades, where you're writing in debits and credits in your manual ledger. You taking this process right now, and again, you can press a button, strike a nav, do a lot of like sort of the work that probably takes even people with technology days to do. You can do this now pretty quickly. So I don't know if it's necessarily ready for showtime as a finished product for firms to use it directly and say, here's my nav, be done with it. But as a tool to get you there, to use the football Eagles analogy, to get you to the 2-yard line in time for the push over the into the end zone. That's exactly what it'll do. So
wonderful. One more question. I know we had a couple of probably recent graduates in the audience. Again, on the topic of AI, Erich, how would you advise? You've got college-age children like I do. What do you tell them about AI? I don't know if any of your children, neither of mine are terribly interested in finance. But so what would you advise an aspiring finance professional to do in the context of AI?
So I think within finance, I think this is probably the most important technology background has been when getting into finance, is what I would say. But I would say the vast majority of what you're going to learn is going to happen once you're there. So, I think I always tell people, Nassim Taleb always said, like, the most important thing is to go to cocktail parties. I think because you just never know what's going to happen. So, like, always continue to network, continue to put your best foot forward, and like, don't be shy about reaching out to people, because you never know what the need is going to be. And I think a good example is the gentleman we hired, you know, in our CVC group came out of Penn. You know, we had candidates from a lot of different universities, but, you know, he had a really strong programming background, which was exactly what we needed. However, in the future, I'm going to need somebody that, you know, has more of a background in, you know, finance and looking at deals. So it tends to be quite random on the family office side. In the VC and private equity, again, I think it's the same formula. It's, you know, do well in school, get your first job, do well, continue to learn, get your CFA, MBA, you know, keep driving and really just keep reaching is what I would say.
I'm
Vineet?
saying,
Yeah, go
I'm-
ahead, Laura.
no, I'm seeing it go beyond just like grad students. I mean, my daughter's 9, and they have them doing projects in their school with video editing processes and all kinds of stuff. And it's things that I would never have imagined could be done. I mean, they're producing like really great distributable video content, which is incredible to see at that age, at 9 years old. It's wild to see how much they're just embracing and adopting it. It's just in their DNA language of what they're doing. They don't even question it. So I can't imagine how it's going to be over the next 10 years once she's in college.
Vineet, sounds like you have a college age child as well, too.
Two. They're both at UBC in Vancouver. Being a Canadian, I took advantage of the domestic rates for Canadian citizens. So I didn't give them the option. I sent them to UBC, but they're loving it there. Very much similar to what Laura said, though, in terms of like the things they're doing at the young age is just blows your mind in terms of how they're embracing technology. And I think it's a great thing. You know, and you know, hopefully hopefully those jobs that we did, you know, out of college, whatever, actually, they probably won't be there anymore. So they'll be taking on a new sort of set of roles and responsibilities once they hit the workforce. So
Awesome. So it looks like we've addressed all the outstanding questions. I'd like to invite the panelists to make any final comments they'd like to make, and then we can wrap up.
Laura, you can go first.
Oh, well, thank you for letting ladies first.
Sure, of course.
No, very much looking forward to 2025 and hoping that as we talked throughout this conversation of the capital markets just opening up and making it easier for some of that liquidity to flow down to the early stages, because I think it will really help a lot of what has been pent up, and just really trying to capture that opportunity throughout not only our fund, but any new funds and entrepreneurs that are needing some of that capital.
I don't have
I'll
a
go.
lot. Sean,
Yeah, go
thanks
ahead,
for
Eric.
hosting. That's all I really have. So
Yes, same here, Sean. This has been a fantastic panel. Love the perspective. Hopefully the same panel we have same time next year will be titled, "Hey, can the good times keep rolling?" Because 2025 was fantastic. So hopefully that's the panel next year.
Exactly. Love it.
Well, I'd like to thank everyone in our audience for registering and attending. We greatly appreciate that. Panelists, again, you've been super generous with your time. I found this discussion lively, entertaining, educational. So again, thank you. And hopefully, if anyone would like to connect with the panelists afterwards, we will be distributing a recording as well as the slides from the event. We'll also get you contact information for the panelists in the event you want to reach out.
Thank
Thank
you.
Everyone.
All right. Thanks, folks.
happy holidays.
Happy holidays, everybody.
Happy holidays.